Hello and welcome back to another accounting video. This is a continuation of the previous video in which we had talked about three different notes receivable that a company had issued, three different circumstances, three different dates. At the end of the year, we had done interest accrual. Let's recap on what we had done in the previous exercise and talk about what we're going to do now in parts B, C, and D. So in the previous exercise, we had three different notes. We're going to look at only the first one. On November 1st, we loaned $20,000 cash to a business partner in exchange for a 1-year 10% note. So November 1st, our journal entry was notes receivable debit, cash credit for $20,000. At the end of the year, when we had accrued interest, the calculation for this particular note is 20,000 times 10% is 2,000 interest for the year. We had the note for 2 months, so we accrued only for 2 months, so we multiplied by 2/12. Now moving to parts B, C, and D, let's take a look at what we have over here in parts B, C, and D, and what we're going to do in these three cases, different cases. In part B, we are told that the note is collected at maturity. 2023, when the note matures, we are collecting on the amount that is due to us. So November 1st, 2023 is 1 year hence. We're going to collect on the note. Now, before we collect on the note, we need to accrue the remaining 10 months interest. So that calculation is going to be similar to what we had done before. 20,000 times 10% is $2,000. Now it's for the remaining 10 months, and that's going to be 16. We're going to round it to the nearest dollar, which is 1667. So my journal entry is first going to be interest receivable debit, interest revenue credit, and the dollar amount we just calculated is 1667. Now what's the total amount that is owed to me? The original $20,000 plus the interest. The interest is 333 plus 1667. That's a total of $2,000. I'm getting all of it. The note has been honored, which means they're giving me all the money. So my journal entry is cash debit, interest receivable credit, notes receivable credit. The interest receivable I just told you is $2,000. The note we already know is $20,000. So I'm getting a check for a total of $22,000. This ends everything I have as far as this note is concerned. The note has been honored. Okay. When we say the note has been honored, it means the customer has paid me in full. They paid me what they owed on the note and the interest on the note. All of it has been paid. So that's part B. That's a happy situation. Now let's look at part C. Part C tells us that assume the customer dishonors the note, which means they do not make the payment on due date at maturity. We expect to eventually collect the note. Okay, so we are saying that we didn't get the money now, but we're fairly confident we're going to get it later on. So what do I need to do? I will first do the journal entry. The date is the same, November 1st on due date of 2023. I'll first do the entry for the accrual of interest for the remaining 10 months, because now I'm saying this customer owes me the $2,000, the same calculation that was done over here, that doesn't change. They owe me that $2,000 and that $20,000, none of which they're paid. So what I'm going to do is, since I'm confident they're going to repay me the money, I debit accounts receivable and I credit interest receivable and the notes receivable. So what I've essentially done over here is these two receivables that I have in my books, I'm replacing them with an accounts receivable. I'm saying it's no longer notes receivable, no longer an interest receivable. I'll bring it back as an accounts receivable. I guess I'll hope and pray that they're going to pay me the $22,000, the original 20 plus the $2,000 interest. Okay, let's take a look at part D. Assume that this customer dishonors the note at maturity. We don't expect to collect from this note. So we've said we're not getting this money. So how do I take the note off my book? So first, to start with, I do the same journal entry for interest accrual. I want to recognize in my books that I am owed that interest. Okay? Customer is not going to pay me. So here's what I'm going to do. It's going to look similar to the previous journal entry, but I'll do one more journal entry and I'll show you what that journal entry is. So I'm replacing the notes receivable and accounts receivable, notes and interest receivable with an accounts receivable, just as I had done over here. However, I immediately turn around and take the accounts receivable off my books. The account I'm going to debit is allowance for doubtful account. If you recall, this was the account that I had created. It's a contra asset account, anticipating some of my receivables are going to go bad. So in order for me to do that, I first bring it in as an accounts receivable, and then I take it off my books. So essentially all I've done over here is I've said, this money is owed to me, and then I'm saying I'm not going to get the money. So for disposal of notes, in all cases we are seeing over here, again, to look at this carefully, I have credited, sorry, that's not what I meant to do there. I have credited the notes receivable, $20,000 in all three cases. In all cases, I credited it because this is at maturity. That money is owed to me. The first case, I said I got the money plus the interest. Second case, I said I didn't get it, but I expect to get it. I brought it as a receivable. The third case, I said, I'm not going to get it. I first bring it as a receivable and I immediately take the receivable off my books, which means I'm taking all these receivables off my books and saying, it's gone. I'm not going to get the money. Okay, so we have three different situations at maturity. First is the note is honored. The second two, the note are dishonored. Part C, we said, I think I can get the money. Part D, I'm saying, I know I'm not going to get the money and taking it off my books completely. So these are very common business situations when you loan money, there's every likelihood you're not going to get that money back.